Hey everyone, this is Addy. So I was a little bit busy for the last couple of weeks, maybe over a month now that I made my last video on YouTube. So here I am again trying to provide a little bit more information on what I have been doing and this blog post that I recently wrote. I got some interesting comments back on my email list, and I thought I'll probably make a video out of it to show what I actually mean by understanding the risk in naked puts, meaning when you sell a naked put, how do you hedge the position when the stock drops? Because your biggest risk when you sell a naked put, your biggest risk is on the downside. When you sell the put, you will be put stock if the underlying goes below your strike price. So how do you defend that position? That's what the video is all about. Trying to give you as much insight, actionable tips and strategies as possible in the next 8 to 10 minutes. Let's see how it goes. So here's the post on my blog. If you want to look at it, go check it out. This is where I post all my blogs. There's a 5-day email course there as well. If you want to take it, it's up to you. If you find if you find my content useful, just go through the website, see what else is out there. But anyway, today we're talking about this is actually my my teammate, my VA, who helps me out with posting and stuff. So that's why the name is coming up from. Understanding the risk in naked puts. So this is what the payoff diagram looks like. Obviously, anything above the strike price is your profit. Anything below the strike price minus the premium that you received. So your strike is at 50 here, for example. You've received $2.5, $2.5 in credit. So now your break-even point is 47.5. Depending on how much premium you collect, that's what your break-even point is. Anyway, let me take you through the platform to actually show you what I mean. Now, this is my paper trading account. I do post my real trades as well in futures options markets. I do not currently have a trade. I recently closed out a crude oil position in profit within a week or 10 days, I think. I forgot to post the closing of that position. I posted the opening of that position in text form because I could not make the video, didn't have the time. But I need to manage my time better and just keep posting video content on whatever I do, however my journey is going, because I've been doing this for the last 8 to 10 years, and this is what I'm passionate about. I read about options. I trade options all year long. Last year was pretty good to me. I was selling credit spreads throughout the year, and they all worked out fine in all the futures options underlyings that are available on Thinkorswim, the Schwab platform. Anyway, let me take you through the example now. Let's go through Apple. That's easily understood by a lot of people. So let's pick it up. Let's sell naked put, and then I'll show you how to defend that position in 4 different ways that I understand are the best ways to defend a naked put. Now, my favorite expiration cycle here would have been the 42-day cycle, but again, these are the weeklies. So I don't touch the weeklies, and I'll tell you why. Because if you open it up and look at the open interest column here, the last one, you see the numbers are like not that great. They're not into some of them are like in thousands, but the rest of them are like in hundreds. I don't like that. Now, if you go into the gray cycle, which is the closest monthly cycle with over 7 days left, the closest one is obviously the 21st of Feb one, which is 7 days away. The next one is 35 days away in 21st of March. Now look at these numbers. This is what I mean. This is why I stay in the monthly cycles. Look at these numbers. They're up in like multiple thousands here. And you can also look at the call side. If you want to check the call side here, the call side column is this one. Look at these numbers. And that's why we try to stay in the monthly cycles, because there is liquidity there. Meaning when you go in and out of the position, you can easily get in and out of the position without giving up too much of your profits. Because if there's not enough liquidity and the spreads are wider, then you will end up giving a lot of bid-ask spread over what you call slippage. Now, we don't want to do that. That's why we stick to monthlies. Now, here's the example. 35 days out, I'm going to sell my 18 delta strike as a naked put. Let me show you everything that goes into selling this put. Your buying power, your whatever usage there is. You see, by default, I selected a spread, and I don't want to do a spread, right? So I want to do a single. I think I selected a vertical there. Okay, let's go through this. So let's select one contract. Always go in with like do not have, each position should only be 2 to 3% of your account size. Meaning, if you have a $10,000 account, each position should only be 2 to 3% max. You should not use more than $5,000, meaning more than 50% of your account at any given time, because you have to keep some dry powder to adjust the positions and to be ready when the opportunity comes. Bigger opportunities, meaning when the volatility spikes, when the market goes down, the volatility goes up. So that you have to be ready for that as well. The other part of that is we always look for high volatility opportunities, yes, but they're not always out there, because 70% of the time vol stays in like a lull state, meaning it doesn't go anywhere, it stays flat. Only 10 to 20% of the time it spikes up, and the rest of the time it comes down. Obviously vol is a mean reverting asset, so it always comes down. But that's the state of the play. It doesn't really spike up much, too often. So we have to be ready when it does. And in the meantime, we sell spreads, we sell other high vol assets, depending on wherever the IV rank is, or implied volatility is of that asset. Okay, so I'm collecting $1.85. Now, if I was doing this in my real account, I would have tried to collect more, but as a limit price. But here, because you're trying to get it done, I'll just take the market is at $1.84, and I'll take that. Look at the top left column here. This is not real-time data, but again, it's really good for practicing. So this I highly recommend. Open up a paper trading account at this software, which is Thinkorswim, and just start trading. Just start putting some money to work. This is very closely aligned with the real markets. It's just that the data is delayed. That's all there is. So let's put this in. Actually, the market has moved, so we're collecting 186 now. Confirm and send. Now look at the straight ticket. What I want to show you here is, forget the break evens. We look at that on the chart. The commissions that you are paying is 65 cents. Now this is how my account is set up. I've tried to lower this commission with TOS. It doesn't work. So that's what it is. This is the buying power effect. This is the main number. This is the risk going into the position, $3,500. Meaning you are putting down $3,500 to initiate this, which is fine. That's not a big, a deal breaker here. Let's analyze this trade first. Okay, let's take this out. So to analyze the trade, you have to select the right expiration cycle, the right break even. So 322 is the expiration cycle, and on top right here, you have to select the same date. So then the chart looks better. Now look, this is the number I care more about, this probability of profit, meaning I have an 82% chance of making money in this trade. Why is that? Is because we are selling, it's just a inverse of your delta position. So your delta, you're picking 18 delta here, right? 100 minus 18 is about 82. So that's what your percentage of profit is, probability of profit is. So this is the number that we like. Now, if you hover over this line, of the steel line here, and look at the bottom left part here, your max is 186. That's the amount you collect. But you will pay commission, 65 cents to go in, 65 cents to come out. So be mindful of that. Plus 65 cents for every adjustment that you will make. So be mindful of that. The commissions can eat up your profits, especially in the futures options market. The commissions are higher because the exchanges are involved, right? Like the CME is involved for the futures. CBOE is involved for the options. Now, why do we do that then? Because it gives you leverage, meaning they don't. So how this trade is asking us for $3,500 down to make $186. In the futures options market, if we have done it on a index or a commodity market, this would have been $300 down, $400 down, and we could have made the same amount of money. So that's what the leverage is. And that's why I stay in the futures options market more, because the leverage is better, the margins are lower, and that's why we stick there. Anyway, I think we're almost in 10 minutes. I don't want to take too much time here, but okay, so let's just put this position in. Let's put it on first. Let's send it. One contract. Let's see. Okay, it's filled. Now I have the position on in my paper trading account. Now, how do I defend it? Let's go line by line on what is it that I'm talking about here. So first of all, let's say you sold it at this strike, right? The strike that we picked was like 240. This is the strike price. I think 230. 230. Yes, we picked up 230, right? That's good. So now let's say the market drops. If you come here and you look at this position, it shows you that you have a position on. If the market drops, then our short put is now tested, meaning if it drops below 230, you will be given 100 shares of stock at 230. Let's say if the market is trading at 220 now. A month has gone by. You haven't done anything about your position. You haven't adjusted. You haven't rolled. The market is trading at 220. You will be given this position. They put 100 shares of stock, and your option will be closed out, but your account will be credited with 100 shares of stock. Your money will be taken away based on 230 times 100. That's the amount of money that will come out of your account if this stock is put to you, if you don't do anything about your short put. So what do we do? First thing I would show you is I would convert this into a spread. If my short strike is here, let's say a month out, the short strike is trading at 220, I will go out another $10 and I will buy a strike. Meaning I will put this order in, convert this into a spread, take it to the Analyze tab. This is how the spread will look. Your risk will only be 1,854 at that point. Well, depending on where the market is. Right now, that risk is 1,854. So I'm going to put this order in. But look, you're paying 40 cents for the put right now. Be mindful. When the market drops, this put price will be a lot more than 40 cents because the market is now, dropped on you. The short put will also be trading higher. So we collected 186. Let's say the short put at that time is trading at like $5 or something, okay? And then the long put is trading at maybe $3. So net, you will be out by $5 minus 186 because you will be buying this. That's what your paper loss will be. But you're not closing the short put yet. I'm just showing you how to add another put to convert it into a spread. Let's say for this one, this is trading at $3 at the time. You will pay $300 to put this thing on. And how would you do that? You will select the strike, $10 out, or however much your risk profile, whatever your risk profile is, you will convert this into, or however many delta you want to close out. So let's say your short delta is now trading at, you started at 18, it is currently at 30, 35. You want to go out and buy a 20 delta put, and your net delta position will be then 15 delta short, which is fine. So you will right click, again, confirm and send, and put this thing on. There will be no buying power effect because when you convert from a short, like a naked position, to a spread, they don't charge you more commission or more margin. So don't worry about putting more margin. In fact, you will get some margin back because now your net loss is only $1,854 versus before Apple stock could have gone down to zero, and that's what your max loss was. At the time when you put a naked position on. So you will put that on, get some buying power back, and then you will look to redeploy or wait on this position at the time. This is one way of doing it. The other one is you also you can roll down and go out and collect more premium. What do I mean by that? So what do? You have a short position here. When you roll down and out, meaning you buy this one back, at that time it's probably trading at, let's say, $5, like I said. So you sold it for $190. It's trading at $5. Let's say let's say $3.10 loss. So you will buy it back for $310. You sold it for $190. Your $310 is your net loss in this because you're buying it back for $5 and you sold it for $190. So your net loss is $310. You will close this position out. You will go pick up the next expiration cycle. If you are still bullish on the stock and you think that it will recover after dropping that much, you should always go out and sell another put if your market direction has not changed. So you will pick a longer expiration cycle. You'll go down again 16 to 18 delta, sell another short put here. Naked put, it's totally fine. Don't worry about your paper losses or buying it back. It's not a paper loss. I get it. It's a real loss because you're buying the position back and now you're selling another one. But your market thesis has not changed. You're still bullish on the stock. You're still bullish on the underlying asset. And you still want to put this stock at a lower strike. So if you think that you're a long-term holder of this position, you can hold this long-term. This is what you want. Keep selling short puts. Keep selling naked puts. It's the best way to get put stock to you in a very discounted way. Or actually at your on your terms, at your price, because you're choosing the strike here. So sell another put, sell another naked put, sit on it. If that goes bad, I would say convert it into a spread. Always convert these things into a spread if it doesn't go your way. And then you can also move the spread out as well. You can take the spread out, keep taking the spread out, keep moving the spread out to other expiration cycles. This is one way of doing it. I've shown you two ways: converting into a spread and then rolling down and out for more premium. You will collect more premium. You will improve some of your break even, but you will take a hit on the P&L because you are buying back a more expensive option than what you sold it for. So that's a loss, but that loss will recover if your thesis stays correct. If you're right on the market and you still want to hold it. The next thing I talk about is buying the stock back. Now, what do I mean by that? When you are short put, they charge you a lot of margin, right? Like we saw, $3,500 to make $180, $190. If you buy the stock outright, you will get that 50% margin from the broker. They will only charge you 50% of the total notional of that position. So 100 times whatever the stock price is, you divide that by 2. That's what you pay to get into that position as 100 stock. So this part here, buying the stock to create a covered put, is solely to recover some of your margin. And because you want to hold the stock and you were a long-term, you were long-term bull on this stock, it's already dropped. It's come below your strike price or below where you were thinking about where it will go. So it's a good time to buy the stock, right? So I would just go ahead and buy 100 shares of stock. Now with the short put, I will still leave it on, but your margin will be released. A lot of it will be released because now you hold the whole position. This is like a cash secured put now. Now this is like you've already got the stock and you're selling the put on it. So I would keep the short put out, or if you want to close it out, take the loss, just close it out because now your stock price your cost basis has improved because the market has gone down a lot. And right now you're liking it at 220, you will love it at 210 if it drops, right? That's human psyche there. That if you were liking it at 210 or you're liking it at 220, you would love it at 210 or 205 or 200. So if it drops that down, at that point, close out the short put. If you want to leave it on, play the market out, for a longer time, I would say roll it out in the next cycle, but hold the stock because that's what you wanted to do in the first place. The last one is way of treating this short naked put is accept the assignment. Take the assignment, like I said, instead of buying it, you can just wait until it gets assigned to you. Sit on that short put, let the broker do its thing. They will put stock in your account, take cash out of your account. What cash? Whatever your strike price is, 230 times 100, that's the amount of money that will be credited from your account, minus all the commissions and stuff. There's assignment commissions and whatnot. Your short put will go away. Now you're sitting with 100 shares of stock. What do you want to do with that? If you think that in the near future, you want the market will go up, or it will stay sideways, or it will neutralize a little bit, then you can sell covered calls, collect premium on the other side. I do this in my stock positions. On my stock positions, I go above my profit target. So let's say if I bought something at 50, I would try and sell it at 75 or 80 or 90 strike. Month out, 2 months out, 3 months out, depending how liquid the market is. The only problem is that if it drops below 50, that's where your covered calls are then you cannot sell it, right? Because then you cannot sell calls on it. Because let's say you bought it at 50, now the stock is trading at 30 or 40. Now when it's trading at 40, you're not getting enough premium at 60 or 70. So you want to hold the stock until it goes up to 75, and that's when you want it to get called away. But you are not getting that 75 strike. You're not getting enough premium in that 75 strike because the market has dropped too much. So I would rather than just wait until the market recovers within your range, then you start selling calls again. Remember, you are holding the stock. Stock market going up on your covered calls is always a good thing because you are making money on your stock. Yes, you are losing a little bit on your covered calls because those are getting tested, but it's always a good thing. This is the best thing that can happen to you because the stock is moving up. If you don't want your stock to get called away, close the short call out. Go further out in time and sell it. But like I said, to protect your margin, to protect your buying power, always try and convert it into spreads. And then you can also keep moving the spreads out. Do it that way. That's what I do in the futures options market. That's what I did all of last year. Made good money out of on my account because I was always controlled with a spread. Never lost sleep on it because I knew what my max loss was. I knew what my max profit was going in. These are the 4 ways I think are the best ways to handle a breached short naked put strike. Now, if you can come up with any, just let me know in the comment section. Let's discuss it. But stay tuned for more videos. I'm going to be posting a lot more. I do apologize. I've been out of touch, missing in action for a little bit. But the idea is to cover a lot of different topics. My next one, the one that I'm really fascinated about right now, is the IV rank. The IV rank and implied volatility. Why do we need both of those? Is one of them enough? I don't think so, but that's what it is. Thank you everyone for watching. Hit me up, follow, and put some comments on. Thank you. Bye.